Trying to figure out if a company is healthy by looking at just one financial statement, it's kind of like going to the doctor and having them try to diagnose you with just a thermometer. I mean, sure, your temperature is useful, but what about your blood pressure, your medical history? You need the full picture, right? Well, it's the exact same thing with companies. You look at one number in isolation, and you are absolutely going to miss the real story.
So, that brings us to the big question we're going to tackle today. Is a company that's making a profit always a healthy company? On the surface, you'd think, yeah, of course, profit is good. But as we're about to find out, the answer is way more complicated and honestly a lot more fascinating than you'd think.
All right, let's start our investigation with the one financial statement everyone knows and talks about. This is the profit story. It's all about one thing. How much money did the company actually make?
And that story is told through the income statement, or as I'll often hear it called, the P&L. Now, the best way to think about the P&L is like a movie of the company's performance over a certain amount of time, let's say for a quarter or over a whole year. It logs every single dollar that came in the door and every single dollar that went out.
The plot of this movie is pretty simple to follow. You start at the very top with total sales, all the money they brought in. Then you subtract the cost of actually making the stuff they sold. That gives you the gross margin. From there, you take out all the other costs of just being in business, marketing, salaries, rent. That gets you to operating income. And finally, after you pay the government and the bank, what's left over, way down at the end, that is the famous bottom line, net income.
But here's where it gets tricky. There's a really important limitation to this, and it's that financial statements are all about the past. They're historical. So while the income statement is absolutely essential, it's a bit like trying to drive forward while only looking in your rearview mirror.
And that rearview mirror view introduces the biggest plot twist of all. It's this concept called accrual accounting. Here's what it means. Companies get to record a sale the second they earn it, not when the customer's cash actually hits their bank account. So think about that. A company can show a huge profit on paper, but its bank account could be totally empty. And that, my friends, is where our little mystery begins. Okay, let's keep building this out. So, if the income statement is the movie of the company's performance over a year, our next piece of the puzzle is completely different. It's not a movie, it's a photograph. A single snapshot in time.
And this snapshot gives us a crystal clear picture of everything the company owns and everything it owes, but only on one specific day.
This is the balance sheet. Unlike the P&L, it doesn't show you what happened over time. Instead, it just freezes a single moment. It's like pressing pause and saying, okay, right now, what's our financial situation? For example, it'll tell you exactly how much inventory was sitting in the warehouse on the very last day of the year.
Now, what's so cool about the balance sheet is that it's all built on one unbreakable rule. Assets have to equal liabilities plus shareholders' equity. It sounds complicated, but it's not. All it means is that everything a company owns, that's its assets, had to be paid for in one of two ways. Either they borrowed money to get it, that's a liability, or the owners paid for it themselves, that's equity. That's it, and it always has to balance.
So the balance sheet is amazing for seeing things like how much actual cash is on hand, or if unsold products are piling up in the warehouse. It can tell you how much debt the company is carrying. It gives you a great feel for the company's structure. But it's static. It's just a photo, remember? It doesn't show you the flow of the money. Which, of course, leads us to our next big question. Okay, we know the company was profitable for the year, and we know what it owns and what it owes today. But where did the actual real-life cash come from, and where did it go? How did we get from that profit number to this final snapshot?
Well, to answer that, we need our third and final document. This is the one that cracks the case because it follows the actual money.
Welcome to the Statement of Cash Flows. Its entire job is to be the bridge that connects the profit movie with the asset snapshot. It's the translator. It takes that on-paper profit from the income statement and explains exactly what happened in the company's real-world bank account.
And here's the magic of how it works. It starts with that net income number from the P&L. Then it makes a bunch of adjustments to get us back to real cash. For instance, it adds back expenses that were on the books but didn't actually cost any cash, like depreciation. That's just an accounting idea. No money actually left the building. Then it looks at cash that got tied up in operations, like buying more inventory. And finally, it tracks cash from the big stuff, like buying a new headquarters or taking out a huge loan. The final number? It perfectly explains the change in the company's cash balance down to the penny.
So, we have our three clues: the profit movie, the asset photo, and the cash trail. Now it is time for the big aha moment, where we connect all the dots and see how they tell one single story.
And here it is, the most important takeaway of all. You you literally cannot, get the full story from just one of these statements. They aren't standalone documents. They're designed to work together. They are critically, fundamentally interconnected. And this diagram just shows it perfectly. Take a look. See that net income number at the top from the income statement? That one number is the linchpin. First, it flows directly into the balance sheet, making the owner's equity part bigger because, hey, the company made money. And at the exact same time, it's the starting point for the entire statement of cash flows. They literally feed into each other. It's a perfect, self-correcting system.
So why should you care about this three-legged stool? Well, first, it hammers home the point that profit is not the same as cash. A profitable company can absolutely go bankrupt if it can't manage its cash. Second, the income statement is never going to tell you if a company is drowning in debt. For that, you have to look at the balance sheet. And finally, it's only when you put all three of them together that you get that comprehensive health check, the full story you need to make a smart decision.
So the next time you're looking at a company, don't just stop at that flashy profit number. Look for the complete narrative that's being told across all three statements, because now that you have the framework, you'll be able to see the real story.